So the limit order got triggered on the 71 level. I was in the trade, we were in the trade, and price started to push deeper. We take partials at minus 20.7 Fibonacci level, which is Alright, welcome guys, it's Marcel here, and here I'm with a new recap video where I'm breaking down a trade I took on EUR/AUD, a sell, where I closed the partial TP and the rest of the position did hit break even. So everything was forecasted, everything went according to the forecasted plan except one thing, so please keep watching the video if you want to find out what was that one thing. So first of all, 4-hour structure, what we get here on EUR/AUD is that price been really nice bearish ever since the creation of this external or swing high point. And ever since price broke the last recent protected low point, it was sure that the price is trending into a bearish market. So if we are focusing on the last recent leg, what took place on in this region is that price broke the low point here, created a new external break, created a pullback, then from this pullback went into a bearish direction again, then it swept out the high point, grabbing the liquidity of this previous high point, and from there it could finally break the low point again, creating a new continuation break here. If you're watching this, you already know how frustrating it feels to almost get it right in trading, spotting the move but missing the entry, or catching a win but giving it all back next week. Inside flipping markets, we fixed that. You'll learn the exact strategy that generated me over 7-figure in profits over the last few years, from 4-hour structure down to the 15-minute entries, with an A to Z course and playbook, with daily chart insights and forecasts, weekly live webinars, psychological coaching, recap videos, case studies, fundamental technicals, and many, many more. It's not just a random signal group or hype nonsense, it's a real trading community where people actually get funded and stay consistent. As you can see it on my chart, we have turned more than 3,000 traders into funded traders over the past few years. So, if you're serious about your trading and turning into something real, hit the link in the description, join the academy, and I will see you on the inside. And now let's just get back to the charts. Ever since this new continuation break, price been going into a nice bearish direction over and over again, leaving several Fibonacci regions behind, several Fibonacci ranges we could pull. So basically we just pulled the Fibonacci range from each high point, from here, and from here, and also from the protected high point. But you know, this is a 4-hour trading purpose Fibonacci where you can set a direct limit order on the 71 level. And everything else that was not the protected level was a simple 4-hour trading range pulled from this high, and this high, and we have been expecting a bearish confirmation on these 71 levels right there and right there. So the last recent 71 level, if I zoom in, you will see that it has been created from this high point where price created a pullback after this bearish movement, pullback, and from this pullback it broke the low point again, creating a new continuation break. So this is the last recent bearish Fibonacci range, and we focus on this 71 level as the last recent plan. When there's a last recent level of Fibonacci 71 level, we always mainly prioritize that level, and we just simply expect our confirmation entry model to be printed there. So price basically came back up to mitigate this 71 level, but it missed the mitigation with like 0.5 pips. If I switch down to the 15-minute time frame, you will see that, yeah, here was this range. Sorry, before breaking down the 15-minute time frame, I'm going to show you the actual forecast that I have sent you one day prior this trade. So this was a trade, right? I marked out these two levels in the forecast that I sent you in the markup section of the Premium Academy. Marked out these two levels and just simply stated, plan is simple. If one of the 70 levels are getting confirmed, take shorts. You know how to apply the 15-minute confirmation model because there's a complete video course about explaining how to apply these entry models. So basically, here is the 15-minute time frame breakdown. Price came back up to mitigate the 71 level, but it missed the mitigation by 0.6, 0.7 pips. So not even a pip. All right. So, you know, this is the one thing I told you at the beginning of the video, that everything went according to the forecasted plan, expect one thing. And that one thing was the miss mitigation. But fortunately, we have an educational video about this topic, that what happens when price misses the 71 level mitigation by 1 pip. And I'm just simply linking this video right here. It can be found on WAP in the trade recaps and case studies section. This is the exact video I'm talking about. Education. This is how recap videos are built up in our academy. That we have a recap video breaking down the trade, for example, like this Euro AD, and there's always an education topic at the end of that recap video, or in the middle of that recap video while I'm explaining something. I always add an extra educational topic, which can help you to further craft your trading abilities. So in this video, there was one education topic simply highlighted here, missed 4-hour 71 level mitigation by 1 pip, what to do. And this video exactly explains that what to do in this case when price misses the 71 level mitigation by 0.1 to 1 pip and then reverses and creates a confirmation model. So check this video out if you don't know that what to do in this situation. I'm not going to explain it again because there's this video dedicated to this topic exactly. So please watch it. All right, so going into the depth of this breakdown, into the depth of this trade. So what took place right here is that price, as I told you, missed the 70 mitigation by 0.6 pips. And then it shifted the market structure. Basically, I would say that this is the less recent external market structure low. Here was a market structure shift. Why is this the less recent external low point? Because the last recent low point is the one that created the last recent break of the structure. This is the last recent break of the structure. I won't be titling this as a break of the structure because this is powered by not news but by the market open. So this was a market open gap. This is a gapping candle, which means that this candle doesn't even exist. You don't even have to care about this candle. It's not there. Think about it like it's not there. Market open candles, market open gaps are not there. It's just Fugazi, fairy doesn't exist. Here, after this Fugazi candle, price just wigged out the previous high point, so therefore this could be the less recent market structure low point, but there's no real market structure detected here because price was ranging, and in that one single range it wigged above. This is basically can be created by the market open as well. It was like, yeah, 45 minutes after the market open, Asian session goes crazy when the market opens. So, we don't even care about this, but it just almost mitigated the 71 level. So therefore, after the 71 level mitigation or mismitigation, price started to drop down heavily. And then it shifted the less recent low point that created a less recent variable break of structure to the upside. Now, this overall range that, led down to this low point could have been pulled, but the 71 level had no volume, there was no criteria needed for a trade, so this became a 15-minute swing trading range. And what do we do with swing trading ranges? There's an educational video about this topic as well, explaining the course, that will reconfirm this. If this range is untradeable, but you find the direction really strong, on the 4-hour time frame, which is really strong. Price is dropping down heavily, mitigating 71 levels over 71 levels. And then a confirmation is getting printed after a 71 level mitigation. But that confirmation is not tradable. We just simply reconfirm this area. So if price comes back up to this region and creates the confirmation entry model, then, we can just simply enter in the trade again using the reconfirmation entry model. So let me just replay price back to show you what has happened here. Price been coming back up to this 71 level. And after reaching the 71 level, it just simply rejected there, started to hesitate with few more candles, rejectional candles. And after hesitating, after rejecting there, after creating a little bit of indecision, price created a new high point right here. Here was the less recent high point, created the pullback of this less recent high point. And then after creating the pullback, it just simply swept out the high point again. There was a sweep of liquidity, meaning price grabbed the liquidity of this high point, because why is there existing liquidity above this high point? How does this liquidity work? I mean, what is liquidity in general? I'm not going to, host an in-depth 3-hour long speech about liquidity, but I'm just going to explain the logic behind this simple liquidity pool that is located right here. So basically, what you see right here is that price created this bullish movement, created a little hesitation stage, and then a nice bearish drop down took place with a really, sizes gap of candle right here, almost 18 pips of a candle. And you can see that a volume got created on this candle, not because of this volume gap that took place in between the wick order block and the third candle, not because of this volume gap, but you see from the size of the candle that, yeah, many orders been placed here. First of all, there is no bottom wick, meaning there was no hesitation at the sell, buy, battling between the sellers and buyers. No hesitation at all. Price just simply took the liquidity of this previous candle and then dropped down. Without a single hesitation, bears kicked in. Therefore, you can see the footprint of price that many people open positions here. You can see that price pushed from this region really significantly, meaning many orders took place here, got entered into market right here. Many orders got fulfilled because basically this is the 50% of this overall range in between the 71 and the 1 Fibonacci levels. So stop losses exist above this high point, because if orders got opened right here, meaning these orders have a stop loss somewhere, right? And the stop loss of these orders are mainly at the high point or few pips above the high point. So therefore, when price came here to grab the liquidity of this high point, grab the stop losses of the high point, you can see that this is the less recent region where the stop losses got triggered. Price triggered the stop losses, and from triggering the stop losses, it just started to drop down again with the exact same bearish pressure, now with continuous bearish candles. Let me just play a few more candles ahead, and you will see that this was the exact entry model that I took here and we took in the academy, because price took the liquidity of the previous high point. From taking the liquidity of the high point, it pushed down and basically broke the less recent low point that directly took the liquidity of the previous high point. So therefore, there was a market structure shift, because this is a low, this is a high, this is a lower low, higher low, and this is a higher high. So this is a structure we see right here. From this low, price took out the liquidity, and after taking out the liquidity, price broke the low point that took the liquidity, meaning there's a market structure shift. So in this case of having a market structure shift, we just simply pull a Fibonacci from high to low. And then on the 71 level, if we can find volume and order block at or above the 71 level in a selling scenario, in this case, we have a wick order block. You know what wick order blocks are. We have an educational video about that as well. So there was a wick order block from where the wick volume started. There was a nice volume gap in between the wick and the second candle stop. Volume gap being created there. So we could pull a Fibonacci from the high down to the low, and there was the 71 level located just right here. Price mitigated the 71 level, and that was the entry right away. So the limit order got triggered on the 71 level. I was in the trade, we were in the trade, and price started to push deeper. We take partials at minus 20.7 Fibonacci level, which is 3.3 risk to ratio or percentage profit exactly. We take partials right here. After I took the partials, price kept pushing deeper. Actually, the final TP was the 0 level, not the Fibonacci, not the 15 mid, but the 4-hour external level, because we always target 4-hour external levels once we enter in a 15 mid trade. So after taking the partials and making some nice profit right here, price kept pushing deeper, a little bit deeper, and this region, when price reached the deep bottom, this was at around 5 risk to ratio, 5.3 risk to ratio. It decided to reverse to the upside and take me out in break even, because yes, after price reaches the 0 level and breaks the 0 level, we do set the positions to break even, as you know. So after taking breaking the 0 level and taking the partials, I did set the position to break even, and price came back up to take me out in break even. So the overall result of this trade is a partial TP on the minus 20.7 Fibonacci level, closed out a nice partial profit, and then the rest did hit the break even. And this is the final breakdown of this trade. And thank you guys for watching this video. If you liked it, please just subscribe to the channel, leave a like, and write something nice in the comment section if you want to see more of this in the future. So yeah, thank you for being here. Appreciate you all. Take care and goodbye.